Good afternoon. Happy New Year, everyone. My name is Nicholas Kapitzis. I'm able to moderate today. For those who don't know me with my complicated name, just think of Kopisi when you think of Kapitzis. So I look after the distribution for PineBridge across Asia and EMEA. I'm delighted to be here with you today. 2025 will be an interesting year, I think, for markets going forward. PineBridge, for those who don't know PineBridge, we run about $200 billion US dollars under management. We're a global asset manager focused on fundamental, active asset management headquartered in the US. As kindly introduced before, we have Elizabeth to my left and Jeremy on my far left. Elizabeth looks after our Asia equities. She's the head of Asia equities at PineBridge Investment Management. Been running money for a long time. She's been with PineBridge since 2008. Ran money at Standard Life, also at Allianz Global Investors and Schroders before joining us in 2008. Jeremy has been with PineBridge since 2017, sits in Singapore, Senior Vice President on the Asia Fixed Income team. He's a Deputy Portfolio Manager for our Asia Pacific Investment Grade Bond Fund. So today we're introducing our Asia Investment Grade Bond Fund, a fund that has done very well for investors over the last few years, purely investment grade, purely a US dollar, and capturing the investment opportunities across APAC, from Japan all the way to Australia. Elizabeth, who runs the Asia ex-Japan Small Cap Fund, jointly, Jeremy and Elizabeth run an Acorns of Asia Balanced Fund, a multi-asset fund, a diversified fund, including Asia ex-Japan Small Cap and Singapore Dollar Bond. So with Trump coming into the office next week, interest rates normalizing, geopolitical tensions, let's jump into you, Elizabeth, for your first question. China is on many people's agenda, and we've just heard a great presentation and a promising outlook on China from our previous speaker, but it was deemed uninvestable. What are your views, Elizabeth, on investing in China equities for the year ahead?
Thank you, Nick, and thank you everyone for coming today. I think with Trump coming up, the thought of everybody is saying that China is really uninvestable, but I think the uninvestable portion is really on the macro level, where people just look at the fear factor. That China has no companies that's worth looking at. But then again, when you look at the companies that actually did well over the last 5 years, you actually do find an auto company, which has made over 300% return over a 5-year period. You do have a battery company that made over 150% return. So do you call that uninvestable? It's really back to stocks and back to companies. And when you look at China, the perception a lot of people have is China 20 years ago, where, just making clothes and shoes. But in fact, China has evolved beyond low-end manufacturing into high-end manufacturing, and that's where China is very focused on. So to be honest, I don't think the government of China wants to focus on the low-end manufacturing. You can take that away, that don't really bother, but they're really very focused on high-end manufacturing, and that's where we really put our efforts on, which is looking for stocks in those areas. So I don't believe that China is uninvestable. There are so many good quality companies there. And when you think about exports of footwear and garments 20 years ago, just project that for high-end manufacturing components that will take over this export factor for China. So I think I do believe that it is very investable. Thank you.
Thank you, Elizabeth. I had an interesting discussion with someone at our booth. Do come and visit us afterwards about investing in ETFs versus an active fund. And I think what you just said, Elizabeth, really is important, especially investing in China. You have to be active. But moving on to fixed income, where active management is also very important, and China equity being very different to Chinese bonds. How does China play into your expertise and your fund, Jeremy, when you look at investing across APAC?
Yeah, thanks, Nick. So, very good afternoon to everyone. I think China has materially changed in the overall Asia credit space over the last few years. If we look at the Chinese property sector, I think that's a sector that everybody reads headlines on. It has essentially shrunk to a mere 1.5% of the overall market. So the truth is that a sector like Chinese property is no longer as impactful, no longer as influential anymore, right? If we look at the overall Chinese bond space, and I'm talking in terms of USD denominated bond space, and if we look specifically at the investment grade segment, China used to be about 50% of the market. Right now, it has also shrunk to just slightly above 30%, right? For us, we very much agree with what Elizabeth has said. We do believe that China still continues to be very much investable. And we still think that there's good value in some of the China investment grade bonds. However, when it comes to China investment grade bonds, right now, we are actually running a pretty large underweight. And the primary reason for that is really down to its very expensive valuations, right? So for us, we do prefer to actually position ourselves in areas like the Japanese USD denominated bonds, where we do like the insurers, the banks, as well as a couple of corporates over there. We also do like the Australian USD denominated space, where we do have a pretty favorable view on the Australian banks, as well as some retailers and real estate players. And within traditional Asia, I would say that we still see good value in some of the Korean investment grade bonds, as well as some bonds in this region, right, ASEAN, where we still think that there's good value to the overall portfolio.
Thank you, Jeremy. Elizabeth, you're an award-winning PM for Asian ex-Japan small cap funds, as well as the PM for the Asia Acorns of Asia Balance Fund, again a combination of Asian ex-Japan, small caps and Singapore dollar bond. What's your view on small caps in Asia for 2025?
Yes, I think a lot of people tend to, because of the uncertainties, stay away from small caps. But one question I would like to ask the audience is that, in fact, I should actually rephrase it, like how many people do not own NVIDIA? How many people know about TSMC? I'm sure the bulk of you TSMC. But very few people actually are invested in Taiwanese small cap companies that actually supply to NVIDIAs and the TSMCs of the world. So these are component players trading at very low valuations with very high growth. So we get exposure through Taiwanese companies. So that's actually a bed of opportunities over there. The other thing that we feel very excited about is some of the Chinese small caps. As I know, we've been harping about China and how cheap it is. But the reason why we think it is very, very investable is because there are some companies that actually export and have command a very big market share on a global basis. For example, optical transceivers, which is very needed for all these AI requirements. We have a Chinese company that exports 90% and has 50% market share globally. So, these are companies that people don't really take note of because they only look at the US companies. But in fact, there are very good companies trading at below 20 times multiple listed in China. I think the other thing we are positive on India on the growth angle, but we are cautious on valuations. About 6 months ago, I became really cautious because there was a placement of shares of a company that does bakery goods. And not talking about IC components, high tech, we're just talking about bread and cookies, okay? And they were coming out for placement because obviously the share price was very high. And the valuation was really talking about 50 to 60 time multiple. And basically, the Indian analysts don't think there will be another bread company in India, and this will be the only bread company. As we all know, competition will set in. So I think India has risen significantly over the last 3 to 5 years, obviously benefiting from Chinese demise, but in addition, the discovery of India stock market, which is, I sometimes call it India casino, because of the way retailers have actually pumped the market. So I think when you look at the comparable, the China market does look very interesting, and Taiwanese names as well. ASEAN looking very, I would say, pockets of growth, but also in terms of valuations and currency risk remains there. Thank you.
Jeremy, with you being the PM for the APAC investment grade bond fund, and again the portfolio manager, co-portfolio manager of Acorns of Asia, focusing on Asia investment grade, we saw in 2024 and in 2023 investors allocate to global investment grade, US investment grade, but actually Asia investment grade was a great diversifier and actually outperformed the global and US investment grade market with a lower volatility. What's your view on Asia investment grade, and how can it provide a diversifier in an overall portfolio?
Yeah, correct. So I think, Nick, you have made very good points over there. If I can just show you one chart over here, and if you can just take a step back, what Asia, the chart before? Yeah, is there a chart before that? Okay, so what Asia Credit has done historically is that Asia Credit has actually outperformed global credits on a risk-adjusted basis historically, right? And this is regardless of timeline or time horizon. Asia Credit has given investors a better risk-adjusted returns when it comes to their portfolios, right? Now, for us here at PineBridge, we do believe that these trends are going to continue. And because of that, we think that investors should have at least some allocation to Asia investment grade bonds. Now, if we were to move on to the next slide, I think one key reason why we really have such a favorable view on Asia Credit is really down to its fundamentals. What we have found out is that most of the Asia Credit issuers have continued to display very strong balance sheet and exhibit very stable credit matrix. And that's the reason why we have continued to like this particular asset class. And I think going back to the earlier point on tariffs, which you have brought up, what we have done internally is we have looked at the overall credit market, and this is credit, not equity, right? And what we have found out is that apart from just a selected handful of issuers, the rest of the market, more than 95% of the market, will actually be somewhat unimpacted by any potential tariffs that may come from the new Trump administration, right? The next slide over here essentially shows you what we have done internally as well. And this is a study that we have done essentially including some Asia investment grade bonds into a portfolio of global investment grade bonds. And what we have found is essentially showed on this slide. It will effectively dampen the overall volatility of the fund, thereby giving the fund a greater risk-adjusted return, which is essentially what we are all after, right? So I think the key message on my part for today is really it's not only about being in global investment grade or Asian investment grade. They should not be mutually exclusive. I think investors should essentially not only diversify across asset classes, but within asset classes, and have those two strategies as part of their fixed income holdings as well. Now, finally, in terms of our view over here, we think that right now is a good time to enter the market for Asian investment grade. And the reason for that is that if you look at overall yields, Asia investment grade yields are actually at close to multi-year high levels, right? If you just look on the table on the right over there, and I know that there's a lot of flip-flopping from the US Fed. Market is pricing in 50 basis points cut one day, 25 basis points cut another day, no cuts another day. But I think what I will urge investors to do is to look through the volatility and look more at a medium to long-term perspective. And if you just look at the table over here, just assuming that there are no Fed cuts, and the US Treasury curve essentially stays where it is right now, and spreads remain somewhat stable, which is what we expect as well, what you effectively get for a A-rated product is a 5.5% return over a 12-month horizon, and we think that that is quite attractive, right? But of course, the key for investors to do right now is really to go and lock in those high yields.
Lovely. Thank you very much, both. I think to conclude, what I got from the discussion and also from the interesting conversations this morning, where a lot of people, a lot of you are investing in the US after a bumper year in the US. People are maybe not that confident about the president, but maybe about his reforms and his policies. But I would not underestimate Asia and the growth that continues to come from Asia. Importantly, diversification is key. Active management, as we've heard before, and from you both, is very much key. So I wanted to thank you all very much for coming. Thank you, FSM, for having us. Happy Chinese New Year, Gong Xi Fa Cai, and have a great afternoon and weekend ahead.